In this video, I'm going to talk about the long-term capital gain and the qualified dividend. So long-term capital gain and the qualified dividends are taxed very differently from your ordinary income, which is you received from your wages, or your retirement income you take out from your retirement account. So it's a very different tax system on your long-term capital gain and the qualified dividend. Here I'm talking about the federal. Will show you here is the tax rate. So if your investment is categorized as a long-term capital gain or qualified dividends, so you will be taxed at a favorable tax rate. You can see here the tax rate is only 3 tax bracket, 0%, 15%, and 20% rate. How this works? First, you can see based on your filing status. So you can see 0%. Say you allow up to 40,400 capital gain or qualified dividend, it's going to be taxed at a 0% rate. If more than this amount, you're going to be taxed at a 15% rate. You can see the bracket quite large. If anything above this, you're going to be taxed at a 20% rate. So this is something, this is the tax bracket. That's how you see it. This is the second is the married file jointly. So how do you understand this though? I want you to think about this as like an additional standard deduction of your income. So you can see here, we all know for your regular income, you get a standard deduction. Like a married file jointly, you have 25,100. Single, you have 12,550, right? And so what does this mean? Say if you married file jointly, you if your income is long-term capital gain or qualified dividend, you allow additional standard deduction is 80,800. So the total would be 105,900. So if you are age older than 65, you can see you allow additional, standard deduction. Then for the single, similar as well. So you basically, when you think about this, say if all your income is a long-term capital gain and a qualified dividend, you think about this, your standard deduction is much higher than the traditional standard deduction. So those are your standard deduction. So basically say if you have in 2021, if you have your qualified dividend long-term capital gain, that's all your income in 2021. If you have anything below 105,900, if you marry file jointly, so you will pay $0 federal tax on it. So simply, I just create this example here. Say Mr. and Mrs. Smith both are retired. They sold some Google stock last year, 2021, and they bought it 10 years ago. They bought this Google stock 10 years ago, generated $100,000 long-term capital gain. They also received a 5,900 qualified dividend from their mutual funds. So their total income in 2021 was $105,900. Assume they didn't have any other income. You can see I made up those numbers so exactly equal to the number here that I call that standard deduction. So $105,900, right? So I exactly made up this number. So the answer is how much is their federal income tax for 2021? I told you the answer is 0. Okay, I want to show you how to get this number. Based on the example number, I use the 1040. Then also another form called the qualified dividend and the capital gain tax worksheet. This is for in the 1040. This is one of the worksheets. You can calculate the tax amount. So here you can see qualified dividend is here. Qualified dividend is part of the ordinary dividend, so you can put the number here. Then you have a capital gain. Here you put the capital gain is long-term capital gain is $100,000. You put it here. So then you get your adjusted gross income is $105,900 here. Then you have your standard deduction. You have your standard deduction is here. So that after standard deduction is your taxable income is $80,800, right? So that's your standard deduction everything. So you can this worksheet will tell you how much tax you're gonna pay total, right? So here you can say the line 1 is from the form 104915. This is 915, 80,800. So you have a qualified dividend. So you go through all those numbers. Eventually, you will have a 0 at the line 25. Tax on all the taxable income is 0. You can see that this one will be entered on your 104916. 104916 is your tax amount 0. So now you can see for the example, basically if all your income was long-term capital gain and qualified dividend, so you are allowed up to $105,900. This is allows this amount if you are married file joining in 2021, so you do not pay any tax. You're probably wondering, Sai, what if I have some other income and also I have some long-term capital gain? And so how other incomes are going to be taxed? Well, let's see this example. I'm just changing the number a little bit so you can see how those long-term capital gain and other income being taxed. Let's say Mrs. Smith, so they are retired, so they sold some Google stock last year, which is they bought 10 years ago, so generate a $60,000 long-term capital gain. They also withdrew $45,900 from their 401k, so their total income in 2021 was $105,900. So assume they didn't have any other income. Well, in this situation, you were wondering, how much is their federal income tax for 2021? The answer is $2,098. This is how the tax works here. You can see $60,000 long-term capital gain is taxed at free. It's $0. You pay $0 on this long-term capital gain. Then how about the money you withdraw from your 401k? Well, is this money you minus the standard deduction as married file jointly, so you get $20,800. So this amount is going to be taxed at ordinary tax rates. So that would give you $2,098. On the form 1040 and this dividend and capital gain worksheets on the form, you can see how this example number showing up on here. You can see here is the 401k 45,900, long-term capital gain 60,000. you have a adjusted gross income is 105,900. So then you minus the standard deduction would give you 80,800. Then you transfer all the number here. Eventually, you can see, I want you to see, I highlighted here. They say you subtract the number, whatever how they get the number, they just showing here $60,000. Say this amount is taxed at 0. So basically, $60,000 is tax free. That's 0 tax whatsoever. Then on the this is 922. They say is the figure of the tax on the 9.5. Basically, I show you the example is there. This number exactly is the the withdrawal from the 401k minus the standard deduction would give you 20,800. Then this amount is going to be used ordinary income tax rate to figure out the tax is $2,098. So eventually you would get this number that's the total amount of the tax they have to pay. Then you can see $60,000 is long-term capital gain is tax free. You're wondering what if the long-term capital gain is $70,000 or other income is a little higher. Well, in this situation, then you will push the 60 the long-term capital gain to the next tax bracket, which is 15%. So I'm gonna back to here again. Just want to show you. So basically, how things works. Say if your long-term capital gain and add or other income together, if it's more than this amount, $105,900. If you are married, file jointly. So if it's more than this amount, your long-term capital gain gonna be pushed to the next tax bracket, which is 15%. So anything above this amount, let's say if you have a let's say 10,000 more above this, then the $10,000 of your long-term capital gain will be taxed at 15%. The rest of the long-term capital gain still taxed at 0. So which means say if your other income is higher, you have a higher other income, those income will push your the long-term capital gain to the next tax bracket, because the long-term capital gain is stacked on the top of all other income. So other income, the higher other income is, so then your long-term capital gain is more likely going to be taxed into next tax bracket. That's how things works. So as long as if you keep everything under this number, if you are married, file jointly. If you are single, is this number. So then your long-term capital gain will be taxed at 0.